Welcome to mutual funds and other investment companies, some of the basics and fees. This is Dr. J. Kent Gregory, and we'll be following, as usual, Jordan Miller and Dolvin's Fundamentals of Investments, 9th edition, McGraw-Hill 2020, and this is coming from Chapter 4. So mutual funds, first some basics. An investment company is a business that specializes in pooling funds from individual investors and investing them. So there are two types. There are open-end mutual funds, and this is an investment company that stands ready to buy and sell shares at any time. And then there's the closed-end fund, and this is an investment company with a fixed number of shares that are bought and sold only in the open stock market. So net asset value, the NAV, this is a mutual fund's assets less its liabilities divided by the number of outstanding shares. So NAV equals assets minus liabilities divided by the number of outstanding shares. An example is, suppose a mutual fund has $200 million in assets, $10 million in liabilities, and $10 million in outstanding shares. So the NAV calculation works out to be 200 million rather, minus 10 million divided by 10 million, which gives you 190 million divided by 10 million, which gives you an NAV of $19 per share. And a mutual fund is a corporation owned by shareholders who elect a board of directors which in turn hires a manager to run the fund. And there are any number of investment advisory firms out there like Vanguard, Fidelity, Dreyfus, American Funds, etc., that actually create their own mutual funds. Some basics continues. As long as the investment company, i.e. the mutual fund, follows 3 IRS rules, it is considered a regulated investment company and does not pay taxes. So these 3 rules are: 1, it must be an investment company holding almost all of its assets as investments in stocks, bonds, and other securities. 2, the fund can use no more than 5% of its assets when acquiring a particular security. Notice this is a diversification rule. So they're forcing, or I guess you could say forcing the mutual fund to diversify. And then 3, the fund must pass through all realized investment income to the shareholders. So those are the 3 rules. The mutual fund must supply a prospectus and deliver an annual report. Now, often these are combined. And this contains, as you can imagine, financial statements, info concerning expenses, gains and losses, holdings, the fund objectives, and the management of the fund. To reduce costs and complexity, funds accrue all transactions until the end of the day. If you think about it, the fund would have an extremely high number of transactions, particularly if they hold a variety of stocks or other investment vehicles that they may be buying or selling throughout the course of the day. And then, of course, they're going to get buy requests from their investors or sell requests. So they hold everything and accrue everything till the end of the day. So example, an order placed at 11 a.m. is still open, not penned, but open at the end of the day. So let me get my little corrector there. It's still open at the end of the day. As a result, mutual funds are not attractive to active investors like day traders who are doing a number of transactions throughout the day. And this also will help explain why exchange-traded funds have grown in popularity. Unlike with stocks, investors enter the dollar amount that they wish to purchase, not the number of shares. So cost and fees, sales charges, or loads. So there are 4 types of expenses or fees that come with buying and owning mutual fund shares. 1, sales charges and loads. 12B1 fees, management fees, and trading costs. So sales charges are loads. Many mutual funds charge a fee whenever shares are purchased. These charges are called front-end loads, and funds that charge fees are called load funds, and funds that don't charge fees are called no-load funds. So fairly simple there. Front-end loads can charge fees as high as 8.5%, but 5% is typically the norm. Funds with front-end loads in the 2 to 3% range are called low-load funds. And then these loads, meaning the front-end loads, are expressed as a percent of the offering price, not the net asset value. So for example, a load fund with an offering price of $100 and an NAV of $98 has a front-end load of $2, which is, again, 2% of the offering price. Another example, suppose a fund has an NAV of $13.91 and an offering price of $15.20. Is this a load fund? If so, what is the front-end load? Well, yes, it is a load fund because the offering price exceeds the NAV. The load is $1.29, and in percentage terms, the load is 1.29 or $1.29 divided by $15.20, which results in 8.5%. So this is actually a pretty high load, as it turns out. So to continue with loads, some funds have back-end loads, which are fees charged on the redemption of shares. So these fees or loads are often called contingent, so there should be a G in there, contingent deferred sales charges, aka CDSC. The CDSC typically declines over time, so it might start at 6% for shares held less than 1 year, then drop to say 3% for shares held 2 years, and then vanish completely for shares held 3 or more years. Some funds have level loads, where the investors pay an added fee, usually 1% every year they're in the fund. So we're actually building up a lot of fees here, aren't we? The load types are designated by different letters. So A shares are front-end loads, B shares are shares that have back-end loads, and C shares are the level loads. So 12B1 fees and management fees. So 12B1 fees are named after the SEC rule that permits funds to use up to 1% of fund assets to pay for distribution and shareholder service costs. So for some examples, advertising and mailing costs for funds that market directly to the public, or compensation for brokers and service personnel for funds that use brokers and service personnel. Often the 12B1 fees are combined with a CDSC, and these funds often have no front-end load, but make it up with these fees. And then management fees. This is the compensation a company receives for managing a fund. It's charged as a percent of assets held on an annual basis, and it typically ranges from 0.25% to 1.5%. And then finally, expense ratio. This is an all-inclusive fee percentage that includes 12B1 fees, management fees, and other administrative or operating costs. Well, thank you very much for tuning in. I hope all that made sense, and we'll continue on with mutual funds in the next section.